For this presentation, our group conducted a financial performance analysis of two public listed companies in the food manufacturing industry that are listed on Bursa Malaysia, namely Hapseng Industries Berhad and Apollo Food Holdings Berhad. So, the objective of this assignment is to evaluate and compare the financial performance of both companies using trend analysis over 5 years and comparative analysis focusing on key financial ratios. In this section, I will be presenting the background of both companies and their liquidity performance, which includes the current ratio, quick ratio, and net working capital over a 5-year period. So we'll go to company background Hapseng first. Hapseng Industries Berhad is a well-established food manufacturing company in Malaysia. The company is mainly involved in the production and distribution of biscuits and crackers, which its flagship products including Hapseng cream crackers and sugar crackers, which are widely consumed and locally exported to international market. Hapseng operates primarily in the fast-moving consumer goods sector, where demand is generally stable due to the nature of its products, being daily household food items. As a public listed company, Hapseng focuses on maintaining operational efficiency, cost control, and consistent cash flow to support its business sustainability. Next, we'll go to company background of Apollo Food Holdings Berhad. Apollo Food Holdings Berhad is also a public listed company operating in the food manufacturing industry. The company specializes in the production of chocolate wafers, layer cakes, and confectionery products under well-known brands such as Apollo Wafer Rolls and Apollo Layer Cakes. Apollo's products are popular in both domestic and export markets, particularly within Asia. Compared to Hapseng, Apollo focuses more on snack-based and confectionery products, which are influenced by consumer preference and seasonal demand. Therefore, effective liquidity management is important for Apollo to support production, inventory management, and short-term obligation. The current ratio measures a company's ability to meet its short-term obligation using its current asset. Based on the 5-year trend shown in the chart, Apollo Food Holdings Berhad consistently recorded a higher current ratio compared to Hapseng Industries Berhad. This indicates that Apollo has a stronger short-term liquidity position and a greater buffer of current asset relative to its current liabilities. Although Hapseng also maintained a current ratio above 1 throughout the period, its ratio was comparatively lower, suggesting a more efficient but less conservative approach to liquidity management. Next, for the quick ratio. Quick ratio provides a more conservative measure of liquidity by excluding inventories from current assets. From the graph, Apollo continues to outperform Hapseng in terms of quick ratio over the 5-year period. This suggests that Apollo is better positioned to meet its short-term obligations without relying heavily on inventory sales. In contrast, Hapseng's lower quick ratio indicates that a large portion of its current asset is tied up in inventories, which may reduce immediate liquidity. Next, we take a look at net working capital. So what is net working capital? Net working capital reflects the difference between current assets and current liabilities and represents a company's short-term financial health. Over the 5-year period, Apollo consistently recorded higher net working capital compared to Hapseng, as shown in the chart. This indicates that Apollo has more available short-term resources to support daily operation, manage cash flow, and absorb short-term financial shocks. While Hapseng also maintained positive net working capital, the lower level suggests a more tightly managed working capital structure. So overall, in conclusion, both companies demonstrate adequate liquidity positions over the 5-year period. However, based on the current ratio, quick ratio, and net working capital, Apollo Food Holding Berhad shows stronger liquidity performance compared to Hab Seng Industries Berhad. This suggests that Apollo adopts a more conservative liquidity strategy which enhances its ability to meet short-term financial obligations.
Next is the asset turnover ratio, which measures how efficiently a company uses its total asset to generate sales. For Hab Seng, the asset turnover was 1.43 times in 2020 but declined slightly to 1.36 times in 2021 due to COVID-19 and movement control restrictions. After that, the ratio improved steadily to 1.52 times in 2022, 1.58 times in 2023, and 1.6 times in 2024. This upward trend indicates that Hab Seng has improved its operational efficiency and is using its asset more effectively to generate revenue after the pandemic. For Apollo Food Holding Berhad, asset turnover was lower compared to Hab Seng during the same period. Apollo experienced a decline from 2020 to 2022 but showed recovery in 2023 and 2024. Overall, when comparing both companies, Hab Seng consistently records a higher asset turnover, showing stronger efficiency in utilizing assets to support sales. Although Apollo has improved in recent years, Hab Seng demonstrated better asset management across the 5-year period. Moving on to working capital turnover, this ratio shows how effectively a company used its short-term asset and liability to generate revenue. For Hab Seng, working capital turnover was 5.10 times in 2020 and declined during the pandemic to 4.39 times in 2022. However, the ratio improved again to 4.75 times in 2024, indicating better working capital management and improved efficiency after the pandemic. For Apollo, the working capital turnover was much lower, starting at 1.8 times in 2020 and improving to around 1.63 times in 2024. Although Apollo showed improvement, Hab Seng maintained a significantly higher working capital turnover, indicating stronger efficiency in managing short-term resources. Lastly, we look at days sales outstanding, which measure the average number of days a company takes to collect payment from customer. For Hab Seng, the SO remained fairly stable between 36 to 41 days from 2020 to 2024. The slightly increase during 2021 and 2022 reflects lower collection during the pandemic, but improvement in 2023 and 2024 show better credit control. Apollo showed a similar pattern with DSO, increasing from 2020 to 2022 and improving again 2023 and 2024. However, Hab Seng consistently record a lower DSO, meaning it collect receivable faster than Apollo. In conclusion, based on activity ratio, Hab Seng demonstrated stronger and more consistent efficiency, while Apollo showed improvement in recent years but remains less efficiency overall.
Assalamualaikum, my name is Alwani. Today, I will explain the profitability ratio, which measures company ability to generate profit and evaluate its overall financial performance. First is the gross profit margin. Based on the report, Hab Seng records higher margin compared to Apollo for the most of the 5-year period. Although both companies had their up and down, Hab Seng shows stronger performance overall, while Apollo margin improved in the later years. Next is the net profit margin. Hab Seng demonstrates more stable margin, indicating consistent profitability. On the other hand, Apollo showed more frequent change in its net profit margin, but record a significant improvement in 2023 and 2024, reflecting better performance recently. Moving on to the return assets, Hab Seng consistently achieved a higher return on asset than Apollo. This showed that Hab Seng used its asset more efficiently to generate profit. Apollo return on asset is lower in the earlier years but show improvement toward at the end. Lastly, return on equity show that Hab Seng provide higher returns shareholder across in 5-year period, although Apollo's return on equity started lower. It increased noticeably in 2023 and 2024, indicating better return for its shareholders. In conclusion, based on this ratio helps Seng demonstrate a stronger and more consistent profitability, while Apollo show positive growth in recent years. Thank you.
Next, I will briefly explain about the leverage and debt management ratio. The leverage ratios measure the extent to which the firm uses debt to finance its investment, how well the firm can meet its interest payment obligations, and the financial risk related to the financing. Okay, this is the debt ratio for both companies. Group Seng's debt ratio ranged between 32% and 39%, showing moderate but well-controlled use of debt. The ratio declined until 2023 and increased slightly in 2024, indicating prudent debt management and low financial risk. In contrast, Apollo maintains an exceptional low debt ratio below 10% throughout the period, reflecting minimal reliance on external financing and very strong solvency. Debt-equity ratio for both Group Seng and Apollo operate with very low debt-to-equity ratios over the 5-year period. However, Apollo consistently maintains lower leverage, with its ratio declining from 0.045 times in 2020 to 0.03 times in 2024. It is reflecting a highly conservative capital structure. Group Seng also shows low leverage, falling from 0.060 to 0.040 before a slight increase to 0.048 in 2024. Overall, while both companies demonstrate strong solvency and prudent debt management, Apollo remains the more conservative firm, relying more heavily on equity financing and carrying lower financial risk. Okay, this is the last one-time interest earned. Group Seng and Apollo can easily meet their interest obligations. Group Seng's interest coverage is extraordinarily high due to very low interest expenses, indicating almost no default risk. Apollo's coverage is lower but still healthy and improving, reflecting manageable interest costs and stable earnings. In summary, both Group Seng and Apollo demonstrate strong financial health and effective management. Group Seng used moderate debt with high interest coverage, showing operational strength and solid growth potential. Apollo maintains minimal debt and steadily improving profitability, emphasizing conservative, stable financing. Overall, both companies are financially solid, low risk and well managed, with Group Seng and slightly more growth oriented and Apollo focused on long-term stability.